before we start streaming?
Even a connectivity. Where's the connection?
Senator Feldman,
Yes.
will you be so kind and mute yourself? Because we're gonna start streaming.
Sorry about
We
that.
are
It's okay.
streaming. We are streaming now. We're live.
Thank you so much.
Mhm.
Thank you. Good afternoon, everyone. I hope everyone is doing well. These unprecedented times, I pray to God that you're healthy and your families are well as well. I want to, on behalf of Senator Feldman and I and my colleagues that are on this commission and everyone else in staff, I'd like to welcome you to the Maryland Health Insurance Protection Commission. And we are having our meeting virtually today. This is how we're doing things now. And we have a packed agenda. I just want to welcome the commissioners, and we're going to get started right away, okay? Thank you for your time and your efforts. So we're going to start with recommendations on adopting a state-based subsidy program for the individual market. And we're going to have two speakers, the Executive Director from the Maryland Health Benefit Exchange and the Director of Policy and Plan Management. When they speak, if you will be so kind and mute yourself. When they're done presenting, if you could in the chat room, raise your hand, and between staff and I, we'll make sure we look at it so that we don't miss you. As you know, this commission is important because we have a report due that has to be submitted to the General Assembly. And usually the report has recommendations, which many of it has been because of your efforts, commissioners and staff, and have been implemented into law. We'll just get started. Michelle Everly, will you be so kind and get us started, please?
Yes, thank you very much, Chair Peña-Melnyk and Chair Feldman and Commission members. We're delighted to be here today to brief you on the state-based individual market subsidies, as well as the impact of COVID and what it's having on our open enrollment. We are right in the midst of open enrollment for 2021. So we are looking to all of you to help us spread the word and make sure everybody gets enrolled this year. So thank you for doing that for us. In October, we commenced an individual subsidy work group that deeply evaluated not only actuarial analysis, but other documents talking to other states, really looking at a deep dive into what an individual subsidy program might look like for the state of Maryland. On December 1st, we submitted a report to the Senate Finance Committee and the House Health and Government Operations Committee. And today we're before you to share with the Commission the findings of that work group and of the actuarial analysis, and then also to provide you an update on COVID-19 and our enrollments. So with that, I'm going to turn it over to Johanna Fabian-Marks, who's joining me today. She's our Director of Policy, and she and her team have led this effort. And so I will turn it over to Johanna to take you through the findings. Thank you, Johanna.
Thank you, Michelle. Good afternoon, Johanna.
Good afternoon, thank you. And we have slides. I think, Kate, if you're on, you could share those now.
1 second.
Great, thank you. And we can advance forward. So thank you for that introduction, Michelle, and thank you again, chairs and commission, for having us to present. To provide a quick overview of the agenda, I'll first review our work to evaluate a state-based individual market subsidy program. So this is what, as Michelle mentioned, went into the report that we provided earlier this month. So I'll cover some background, some information on the reinsurance program, review who is in the remaining uninsured population in Maryland, and the target populations that we identified for a potential state subsidy, share our modeling and the recommendations of the stakeholder work group that we convened, and then offer some concluding thoughts. So that'll be the bulk of the presentation, but then we'll also discuss the impact of the COVID SEP on exchange enrollment at the end. Next slide. And one more. And so this is the background that Michelle just went over. I won't spend a lot of time on it. But as you know, the legislature directed us to submit a report on December 1st, which we did, and we worked with our actuarial consultants, Lewis and Ellis. We published a report that they created for public comment. And then we also, as Michelle mentioned, convened a work group that provided a report to the exchange to consider in the event we were to implement a state subsidy program. So in the report that we submitted on December 1st, you'll find a lot more detail on the items that I'll cover today, but so that's definitely a great resource. And then of course, happy to answer any questions at the end today. Next slide. Thank you. So that was the background on the report, but I also want to provide some quick background on our uninsured rate, because I think that helps to inform our overall conversation of why we might want to consider a state subsidy program. And I think many of you will be familiar with this. As you can see on the graph here, our uninsured rate, which is the green line in the middle, has fallen by about half since the ACA was fully implemented in 2014, and it's now at 6%, which is well below the national average. That's the blue line above it, but double the rate in Massachusetts, which is shown here in purple and has the lowest uninsured rate nationally. So we know it's possible to continue to improve. Our uninsured rate has held steady at that 6% level since 2016, which prompts the question, what more can we do to drive it down? Who's still uninsured and how can we get them covered? So those are some of the key questions that we kept in mind as we were thinking through the design of potential state subsidies. And before we leave this slide, I do want to point out that nationally, the uninsured rate has ticked up since 2016. So the fact that we haven't seen our uninsured rate increase does put us ahead of most other states. And I don't want to lose sight of the fact that we have a lot to be proud of. But at the same time, we can continue to think about how we can keep improving, of course. Next slide. All right. So I want to provide a quick refresher and some updates on the reinsurance program. And this, again, will be familiar to many of you, but I want to make sure we all have the same baseline on reinsurance as we're discussing the state subsidy program. So as you know, in 2018, legislation was passed that directed MHVE to apply to the federal government for an ACA Section 1332 state innovation waiver to implement a reinsurance program. The feds approved our waiver and we implemented the reinsurance program starting in 2019. Through reinsurance, we cover a portion of insurers' individual market claims, and that results in lower premiums in the individual market. As a result, the federal government's cost to subsidize insurance for low and middle income people is also lower. And thanks to our waiver, the federal government passes those savings on to us to spend on the reinsurance program. And we often refer to that federal funding as pass-through funding. So if you hear me use that phrase, that's what I'm referring to. Next slide. So reinsurance has been very successful. Before reinsurance was implemented, we saw premium increases of double digits in the individual market. You can see that in the chart to the left. And since it's been implemented, we've seen 3 years of double-digit premium decreases, which is great news. Compared to 2018, the year before reinsurance launched, premiums are down more than 30%. And you can see in the graph on the right that our lowest cost plans in the individual market are now about 20 to 30% below the national average, which is, again, wonderful and has really helped to stabilize the individual market. So you may be thinking, well, if premiums are down so much, why would we consider a state subsidy on top of reinsurance? And so if we move on to the next slide, we can talk a bit about that. So the reason that a state subsidy could make a difference has to do with how reinsurance interacts with federal premium subsidies. The benefits of the reinsurance program are primarily felt by households earning more than 300% of the federal poverty level, and particularly households earning more than 400% of the federal poverty level. And over 400% households are ineligible for federal premium subsidies, so they have to pay the full premium amount themselves. Reductions in premiums resulting from the reinsurance program are not typically felt by individuals at lower FPLs under that 400% threshold, and particularly under the 300% threshold. And the bar chart on the right provides an example that helps to explain this dynamic. So on the left, you can see a pair of bars. The leftmost bar, which is labeled with SRP, which is our acronym for the state reinsurance program at the top there, it shows 2021 premiums for a 27-year-old in Baltimore City who has an income of about $32,000, which puts them at 250% FPL, or federal poverty limit. Under the federal subsidy program, this person is expected to pay about 8% of their income towards a benchmark plan. So that 8% equals about $220 a month in premium that they're expected to pay. In 2021, the benchmark plan that they'd be eligible for will cost about $280. So the individual would pay their $221 contribution, that's their 8%, and then a federal subsidy makes up the difference. So that comes out to a subsidy of about $61. So you can see the $221 that the individual pays in blue and the federal subsidy above it in orange. Now you can turn your attention to the kind of faded bar labeled without SRP that's next to that leftmost bar. So this bar shows what we estimate the benchmark plan would cost without reinsurance, which is almost $400. And so in this hypothetical where we don't have reinsurance, the individual still pays their $220 contribution, the 8% of their income, but a larger federal subsidy of about $170 makes up the difference. So with or without the reinsurance program, this person is paying about $200 a month. They're not seeing a reduction in the premium they paid because of reinsurance. That reduction is just resulting in federal savings, which then get passed on to the state to fund the program. In contrast, if we look at the pair of bars on the right, we're seeing premiums for a 27-year-old with an income of about $51,000, which puts them just over 400% FPL. And so they don't qualify for a federal subsidy. They're paying the full cost of their premium. So that full cost that they're paying is the $282, and that's about $110 less than they would pay for this plan if there were no reinsurance program. So when we're talking about premiums are down 30% since 2018, a person in this scenario has really seen their premiums decrease over that time, whereas a person in the scenario on the left who's getting federal subsidies hasn't really seen that change in their premium. So that's an example of how the reinsurance program isn't really an effective way to reduce premiums for individuals at lower FPLs or to target subsidies towards specific populations such as young adults, because reinsurance is such a broad market-wide impact. You can't have these more nuanced impacts on subpopulations like you could with a potential state subsidy program. So just wanted to lay that groundwork because I might have some questions about, how reinsurance and subsidies would interact. So just wanted to share that example, and we can move on to the next slide. So I also want to provide some information on how the reinsurance program is funded, because that ties into the conversation about how we could potentially fund a state subsidy program. The reinsurance program has two funding sources: federal pass-through, as I explained, and then also, as you know, the state health insurance provider fee. That provider fee was 2.75% of health insurance premiums in 2019, and that was reduced to 1% through 2023, which is the term of the reinsurance program waiver. So the current reinsurance program goes through 2023, and then, as you know, we'll need to decide as a state if we're going to apply to continue that forward. And I just want to note here that that federal fee of 2.75%, or I want to note that there was a federal fee of 2.75% of premium, and that was suspended in 2019 and repealed going forward from 2021. So the state fee really kind of swapped in for the federal fee. And the combined impact of the state fee and the now repealed federal fee is a net reduction in premium fees compared to when that federal fee of 2.75% was in place. At the graph at the bottom here, you can see projected inflows and outflows, as we put it, for the reinsurance program. So the pink bar on the left of each clump represents the reinsurance program estimated cost. And that's at about $370 million in 2019 and increasing gradually thereafter. On to the right of the pink bar, you can see the federal funding that we're expecting in green. So as you can see, we're expecting federal funding to exceed the cost of the reinsurance program. This is not what we initially anticipated when we applied for the reinsurance program, but as we've gotten more data and seen the program cost versus the federal funding, we're seeing that we do anticipate that federal funding to exceed program cost. And then to the right of the green bar, you can see the blue bar, which is what we're expecting to collect through that state health insurance provider fee. And so you can see we are not anticipating that we will need to use that on the reinsurance program thanks to the extra federal funding that we're anticipating. And that state funding from 2020 forward, when we're at that 1%, comes in to about $110 to $125 million per year is what's projected. Next slide. So now I want to provide some data on who is still uninsured in Maryland. So who might we want to target with the state subsidy? According to an analysis of census data, and I want to share or emphasize that this is pre-COVID, so COVID may have scrambled and probably increased these numbers somewhat, but we don't have census data out yet that measures that impact. So we're looking at pre-COVID figures here. So pre-COVID, we were looking at about 156,000 uninsured individuals in Maryland who are adults and over income for Medicaid and lawfully present. So this is kind of the target population that we would be thinking about for a state subsidy writ large. And then when we break that down, of this group, young adults are the most likely to be uninsured. So you can see them highlighted in red on the left of this graph. We estimate about 67,000 young adults in this category. That's more than 40% of this total of uninsured adults. And most of these are below 400% of the federal poverty level. So that's in blue and yellow there. So they would be eligible for federal subsidies if they were to enroll in coverage through the exchange. Next slide. So that really helped us in identifying who it might make sense to target for a state subsidy. So we ultimately, through discussions with a previous work group with the MIA, looking at this data, identified two potential target populations for a state subsidy: young adults and households at 400 to 600% FPL. So the young adults were identified as a target population for a number of reasons. As we just saw, they're the largest group of uninsured folks who are lawfully present and ineligible for Medicaid by age. It was a recommendation from a work group that the exchange convened in 2019 to look at the issue of affordability. So that work group back in 2019 recommended that we consider young adults as a target population for a state subsidy. And because young adults are typically healthier than average, they've got claims around 20 to 50% lower than the market average if you're looking at young adults 18 to 34. So because they're healthier, bringing them in and getting them enrolled could further stabilize the market and potentially reduce premiums for everyone who's currently in the market. And then lastly, we know from surveys that we at the exchange have conducted that young adults in Maryland want health insurance, but they struggle to afford it. About 70% of uninsured Maryland young adults said that they would like to have health insurance, but about the same amount said that it's difficult to afford. So, we know that this is something that they'd like, but they're looking at the numbers and it's, in their opinion, not working out for them. The second target population that we identified as households at 400 to 600% FPL. This group was also discussed by the affordability work group as a potential target population. And that's because they don't qualify for federal subsidies, because they're just over that 400% FPL threshold, they can experience a really significant jump in premiums. And that particularly impacts older adults in this income range. So just to share an example, and there's more on this in the report and in the appendix slides, but a couple age 55 to 64, so kind of in our last age bracket before they're Medicare eligible, in this 400 to 600% FPL bracket, could see their premium jump 177% compared to a couple that's the same age but qualifies for federal subsidies because they're just under that 400% bracket. So this is a group that, although they don't qualify for federal subsidies, is quite financially burdened by the cost of insurance if they're coming into the individual market. Next slide. So with these, and one more, with these two target populations in mind, we set out to design some various subsidies to assess what the impact would be on these groups, on the market as a whole, and on the reinsurance program if we were to offer a state subsidy. On the left, you can see the various young adult subsidies we analyzed. So there's a lot of lines and information on this graph, but I'll just kind of summarize it by saying we modeled 8 variations on young adult subsidies, and we targeted mainly people ages 18 to 34. We did do 2 variations up to older ages, one up to age 40 and one up to age 47. And you can see in the graph here, we've just got an example for 100% of FPL. So along the bottom, we've got age from 18 up to 48. And then on the left, so at the top, you can see the dark blue line is what they would pay under the federal subsidy structure. So no matter your age, if you're at 200% FPL, you're paying about 6.5% of your income towards a benchmark plan. Under the subsidy models we designed, you'd pay some lesser percent of your income, from the lowest around 2% up to around 5% at age 18. And then the state subsidy would make up that difference between what you pay and what the federal government will pay, and then what the total cost of the plan is. So you can see most of these phase out as you get older. So you get the most subsidy when you're younger, and then that gradually reduces as you get older until the state subsidy phases out altogether, and you would only be getting the federal subsidy. And for all of the young adult subsidies, we modeled them for folks who are under that 400% FPL limit, so who are not experiencing much of the benefit of reinsurance. For the 400 to 600% population on the right, we modeled 3 designs, and these were simpler. So in the graph, you can see what percentage of income an individual pays as their income increases. So along the bottom is where their income falls in terms of the federal poverty level, and then on the other axis is the percent of income that they're paying. So at the lowest amount, they're paying about 2% of their income, and then as their income increases, they're paying as much as 10% until they hit 400% of the federal poverty level, when they get no subsidy, and then they're paying the full amount of their premium. So we modeled 3 subsidy designs you can see here in the 2 green and the yellow lines, and those would extend a cap on the amount of income that they're expected to contribute. And that cap was either about 10%, which is what it is when at 400% when the subsidies drop, and then slightly higher at 12.5% and 15%. So those were the 3 models of subsidies that we looked at for that population. Next slide. So here I've got a lot of numbers on this chart, and I'm going to kind of guide you through them because this is really the meat of what Lewis and Ellis's analysis revealed to us. So if you can just kind of click through here, I'll have little pop-ups that highlight different parts of this graph. So here we can start. You can see along the left, we've got each young adult subsidy design, and we gave them of names. So I'm not really going to refer to them by these various kind of obscure names, but just these are the 8 various models we modeled. And we've ordered them here from least to greatest impact on young adult enrollment. So you can see at the very top, we've got a baseline, and we put in parentheses with reinsurance. So basically, this is where we are, where we expect to be if we have no young adult subsidy. And then below that, we've got our subsidies modeled. So the least impactful subsidy we modeled, the AASE 34 right under our baseline row, would only have brought 500 young adults newly enrolled into the market because of the subsidy. And that kind of increases down to the bottom version, would bring about 21,000 young adults into the market who would be newly entering and kind of convinced to participate because of the reduction in premium as a result of subsidy. So that's the range of impact that we're looking at in terms of enrollment. And kind of in parallel with that, you might ask, how much is this subsidy going to reduce their premiums? So again, kind of more or less from least to most impactful, the state subsidy would reduce their premiums by about 12%, up to about 60% compared to what they would have been paying if they were only getting a federal subsidy. In dollar figures, that's about $20 to $130 per month. Next slide, yeah, there we go. And the total cost of doing these ranges from about $6 million at that relatively ineffective subsidy at the top down to about $64 million, which would be the subsidy design that would pull in that highest number of young adults. And this is modeled out for the 2024 cost. So our modeling assumed that the impact would increase over time. This is similar to what we saw with the enactment of the federal subsidy program. It took a few years for people to really realize that the subsidy was available and for that to have its maximum impact on enrollment. So that's why you're seeing most numbers here in terms of 2024. If we were able to get federal approval on a waiver amendment, on an amendment to our reinsurance waiver, these state costs of between $6 and $64 million could potentially be offset by up to $12 million. That's the highest amount that we anticipate we could potentially receive. And that's as a result of federal savings that we anticipate from getting these young adults in the market and improving the risk pool overall. So if we click one more time, that you can see here, this is sort of where the federal savings are coming from. Is this what we're calling change in morbidity, AKA, we're expecting a healthier risk pool, and that healthier risk pool to spread premiums around across will reduce potentially premiums for everyone. So we're projecting that impact could be as much as 3.5%, depending on which subsidy design we implemented. So that's, and yes, the last thing I wanted to note here, and I'll delve more into the work group comments towards the end of the presentation, but a majority of the work group that we convened voted that the last subsidy design best met the goals that they established for a state subsidy program. So the majority highlighted that as the one that they would recommend of the ones that we shared. And then sort of similar information that I wanted to share briefly on the 400 to 600% subsidy. So here we've got similarly ranked from least to greatest impact on enrollment. So the impact here is smaller. We're looking at about 2,000 to 9,000 new individuals brought into the market because of this subsidy. And that's because not the subsidy be available to people of any age, but because most young adults are
Can I
already
stop you for
paying
a
less than
second,
10%
Johanna?
of their income.
We're
Yeah.
having a hard time with the audio,
Oh, no.
but
Okay.
you know, can you try it without the video and see if it improves, and maybe walk, stand away from it a little bit?
Yeah, you know what? Let me just try shifting my location. That may help as well. Is this any better?
Yes.
Okay, I'm so sorry about that. Thank you for. All right. So as I was saying, we would expect this. Thank you. We would expect this subsidy design to bring in around 9,000 individuals. And that's lower than the young adult subsidy because this subsidy, although it's available to people of any age, primarily benefits people who are older, and older adults are already more likely to be enrolled in health insurance. So there's fewer of them to bring into the market. We click forward. So the state subsidy here would reduce premiums by about a similar amount on a dollar basis, but percentage-wise, it's lower because premiums for this group are generally going to be higher if you're looking at who's coming into the market because of the subsidy, because they're older. So older folks have higher premiums. So a reduction is a smaller percentage impact for them. And then one more click. The program cost here ranges from about 17 to 70 million. So more costly overall than the young adult subsidy, again, due to the fact that this is primarily bringing in older adults who are going to have higher premiums. And then one more there. Possible federal pass-through around potentially 3 to 10 million to offset the state cost. And then the impact on the market could reduce premiums by up to about 0.5%. So not as significant a potential impact as the young adult subsidy, again, due to the fact that those young adults are healthier, and bringing them in would likely have a larger impact on the overall risk pool. And that is the bulk of what we found from Lewis and Ellis's modeling. In terms of how a state subsidy would impact the reinsurance program, none of the subsidies we modeled would be expected to negatively impact the reinsurance program, and we wouldn't have to amend our current waiver or request an additional waiver to implement a state subsidy program. We could do it kind of independently of the federal government. However, if we did get federal approval to amend our current waiver, and that's uncertain, but if we did, we could potentially tap unspent federal funds as a funding source for the state subsidy program. So as I mentioned, federal funds are expected to exceed the cost of the state reinsurance program. And so that unspent funding, if we got federal approval, we could put towards the state subsidy program. However, if we're only looking at the state funding, so that's the blue bar here from this graph you saw earlier, that could be sufficient to support a subsidy program. And as I mentioned, that state funding comes in at about $110 to $125 million per year. And of the versions that we modeled here in yellow, you can see both a young adult subsidy and a 400 to 600 FPL subsidy. And this is, I think, the most expensive and the second most expensive of one of those combined. And that comes in at less than the anticipated state funding. So all that to say that I think it would be wonderful if we could get federal funding to support a state subsidy, but we could also do it only with the state funding if that was what the state chose to do. And then I wanted to just cover the conversation that we had with the work group and what their work group recommendations were. So they ultimately voted to submit 7 recommendations to the exchange to be considered if the legislature authorizes us to implement an individual market subsidy. And they recommended that we target young adults with subsidies phasing out to age 40, that we target young adults up to 400% FPL. As I mentioned, they identified one of the young adult subsidies as the one that best met the goals they established. And they recommended that we later consider a subsidy targeted towards individuals at 400 to 600% FPL. So they kind of prioritized young adults, but still were concerned with the 400 to 600% FPL population. And then they really highlighted that when considering the effectiveness of the program, that we evaluate how well it reduces racial inequities in health coverage. Next slide. And just a few more, just to put a little bit more meat on the bones for why they recommended that we look at the young adult subsidy for young adults under 400% FPL as that initial target. So there was a lot of conversation within the work group around addressing existing inequities in the individual market, because under the current federal rating rules, young adults do subsidize older adults. They pay more for health insurance than their contribution to claims costs. And that's because an older adult's premium can only be 3 times the amount as of a young adult's premium, but older adults have more than 3 times the claims cost. So that functions to in effect, create a design where young adults are paying more than their claims are costing them. As we discussed, the reinsurance program reduces net premiums for individuals above 400% FPL, but has minimal or no impact on young adults below that threshold. So they felt that a state subsidy program would direct some assistance towards folks who aren't feeling the benefit of reinsurance. And then uninsured young adults are disproportionately likely to be Black and Hispanic. They're about 2 to 3 times more or Black and Hispanic young adults are 2 to 3 times more likely to be uninsured compared to white young adults. And then apart from the desire to address inequities, as we discussed, there's potential benefits to the market and a reduction in the uninsured rate. So if we're going to pick one age group to target, as again, we discussed, young adults are that largest group, and bringing them in could help to reduce premiums for all enrollees. And so just some last concluding thoughts here. So just to wrap up and leave you with thoughts here, I would say our modeling showed that a young adult subsidy at a range of total costs could meaningfully reduce the uninsured rate among young adults, further stabilize the risk pool, and potentially reduce premiums for all enrollees. And that implementing a state subsidy program is not projected to impact the reinsurance program. Annual funding, as I reviewed under the state health insurance provider fee, is projected to be sufficient to fund a subsidy program. But if MHB is authorized to implement a subsidy program, it would probably be prudent to pursue amendment of the existing reinsurance waiver so that MHB could put surplus federal pass-through funding towards the reinsurance program, of course, without wanting to impact in any way the reinsurance program's ability and funding to continue to operate as we've designed it. So just any extra funding that we don't think we'll need for reinsurance. But again, federal approval of that is uncertain. We would be the first state to really pursue that kind of waiver. And given the novel nature of a subsidy program, the legislature may want to consider a pilot program to allow the exchange to gather enough credible data to refine longer-term projections of program costs. So that could be a pilot of potentially 2 to 3 years would be sufficient for us to get more data. And those numbers that I shared with you in terms of the actuarial modeling, those are all just projections. So getting some initial data and seeing how a target population would respond to a subsidy program and what those costs would be would definitely help us to better map out the long-term potential costs and impact of a subsidy program. All right, so switching gears to the COVID's impact on enrollment. So We launched our COVID SCP on March 15th. It's currently open through December 15th. And under that SCP, any Marylander who is uninsured can come to the exchange and enroll in coverage. They don't need to have a qualifying life event like getting married or moving, which is typically what you need to be able to enroll outside of our open enrollment period. They can just tell us they're uninsured and we'll approve them to enroll in coverage. We've seen a really incredible response to that SCP. Over 97,000 people have enrolled, and that's data through December 6th using the SCP. About 2/3 of those enrolled in Medicaid. So of course, Medicaid enrollment is open year round. They did not need an SCP to enroll in Medicaid, but were drawn in potentially because of COVID and enrolled. And then the other third enrolled in private plans, 23% in plans where they're getting federal assistance and 10% unassisted. And overall, the impact in our on-exchange enrollment, so not looking at Medicaid, but just private enrollment, that is up 18% year over year as of October 31st. So you can see in the graph on the right that the green line represents our current year enrollment, and underneath the blue line represents 2019 enrollment. We typically see a decrease in enrollment over the course of the year, but uncharacteristically, because of COVID, we've seen enrollment increasing over the course of the year. And next slide. And then just to give you a little bit more insight on granularly what this has meant. So the graph is a little hard to read, but we've got a paired bar for enrollment under a special enrollment period from 2019 for a month with what it was for 2020 in the same month. So you can see if you look at the March bars, the 2020 bar is outlined in red, and we saw a big surge in enrollment when we opened the special enrollment period that month, and also quite a large surge in April. Since then, we've seen smaller differences compared to 2019. So you can see that the red arrows indicating the change are not as significant as they were in those first 2 months, but cumulatively, as we saw on the last slide, that's really had a big impact on our exchange enrollment. And I think that is the end of my presentation. So I know that was a lot of information, and I appreciate you bearing with me, and we're happy to take any questions.
Thank you, Johanna, and thank you for your presentation and your flexibility to move. We appreciate it. So this is a time where the commissioners are open to ask questions. I want to remind the commissioners and the members that later on after this presentation and your questions, the commissions need to discuss a couple of items. And one of them is whether to provide additional subsidies. And you saw the presentation today, whether we should recommend in the report that we're going to be writing in December, whether to pursue this. And you heard that we don't need necessarily a waiver for the reinsurance program, that we can do it with state fund. And then she went over the different modeling and scenarios. So this is your chance to ask questions, because I'm going to need you, Senator Feldman and I, we need you to basically have a robust discussion as to what will go in that report. So I see Mr. Walters first, followed by Mr. Vincent DeMarco. Will you please unmute yourself? And when you're done asking your question, please mute yourself again so we don't have any interference. Thank you so much. Mr. Walters.
Okay, I have a couple different questions and comments I want to make sure I understand. On page 12 of your graph, when you show the 19 to 34s, almost a third of those people make over the 400%, because it's only talking about 50,000 people that are under the 400% that I see there, the 13 and the 50. So really, you'd be targeting really those 40,000 people basically is who you're talking about targeting, I think. And we're going to miss that 26,000 that are above, that are also have those same problems of probably being minorities. And then so I just caution when we look at that number, because there are a tremendous amount of people that don't have coverage that are over the 400, and you look at the other parts of the graph also. So I just wanted to make that comment. And if you go to page 16, I think there was something there that didn't make sense to me, that in your column J on 16, next to last column, why does it decrease between the last two examples of the percentage increase from 34% down to 30%? In that example, because we've been growing participants or new enrollees as a percentage going all the way up to 34%. Then we drop down to 30%. Is that because you changed the age of giving benefits up to age 39? And in the other cases, you were basically at 34?
Yes, I think you hit the nail on the head there. So in that last subsidy, we've expanded the age up to 39 from 34. So there's a larger group of people who will be getting subsidies. The people at the older age get a relatively lower amount of subsidy because it phases out as you get older. So it's not as kind of impactful, attractive to them. So we're seeing still the biggest increase in enrollment because we've expanded that age amount, that age limit. So we're seeing the 21,000 folks enrolling, but yes, that's a slightly lower percent of subsidy recipients who are new enrollees.
Okay, and my bigger thing, and I'm sure this happened after the study, with the change in administration that's coming in January, there's talk of a change to people qualifying for subsidy based on family income or an employer group, that they could waive out of an employer group and get a subsidy in the exchange, even if their employer was offering coverage that was affordable for a single, but not for a family. What would the effect of that be to this model and overall to enrollment in the exchange? Because then we will have added a whole big new possibility of people coming to the exchange. They couldn't come to the exchange before because their employer offered coverage that was affordable for a single, but was not affordable for that person with their dependents.
Yeah, that's a great question, and that has been discussed. You're right, by a potential fix for the new administration to consider. I think we would expect to see some potential increase in enrollment because there would be a larger group of folks who are subsidy eligible. That would be a new population, but I haven't seen really recent good estimates of those numbers, but the numbers that I've seen are probably smaller, maybe less than 10% potentially of a less than 10% impact on enrollment. So I think we might see some increase, but I'm not sure that it would be a huge increase. But I will say that these subsidy designs were all just kind of options that we modeled to give us baseline to discuss. We, as the exchange, if the board were authorized to implement a subsidy, they might implement something different than this, and they could respond to whatever the current circumstances are from the federal government, in that conversation. So I don't want to kind of paint these options as the only options for what a subsidy design could be, but just some examples.
Well, I've seen much bigger numbers potentially of people that would be eligible to leave group plans and go to the exchange. And that's an overall concern of the effect of that on the exchange in itself. Instead of looking at expanding it this way, the crunch of additional enrollees and subsidies could have a significant effect on the exchange completely in its whole financial position if we ended up picking up a tremendous amount of families that we didn't have before because of the current subsidies. And I know that's high on the list of the administration of changing those eligibility requirements.
Thank you, Mr. Walters, for your questions. Thank you, Johanna, for your answers. Next, we have Mr. DeMarco, followed by Delegate Collison, followed by Senator West. Mr. DeMarco.
Thank you. Thank you, Madam Chair. Johanna, that was a terrific report, Johanna. You and the exchange and your work group should be really commended for this. I really think it really shows the need and viability of a state subsidy program. My only concern was your comment about a pilot. I'm really concerned about doing a pilot when the money's coming in from the assessment, and there are so many people who could get insurance, and we all benefit from taking premiums down. I would really urge not to start with a pilot, but since 5 other states already do this and are doing it well, and you've laid out a really good way, fully funded way to do it, that we go ahead. So I'm just wondering why you have that pilot language in there, and is it really necessary? But congrats again on the great report.
Well, thank you. We appreciate that. And I think it's certainly up to the state whether they wanted to simply institute a program or wanted to make it kind of a time-limited pilot that would be reconsidered after a period of time. I think, either could be successful. I think the reason we included that suggestion of potentially considering a pilot is, as I mentioned, just to provide the opportunity to gather some more data before making a final decision on establishing a subsidy program, and also understanding that there is still a conversation to be had in the state about the future of the reinsurance program. And so that will affect the potential state and federal funding that could be brought to bear for a subsidy program.
Thank you, Johanna.
And
Next
if
we
I
have-
might, can I just add one other bit to that as
Sure.
well? Today, the funding sources that we have today are through 2023. So for not only for the federal reinsurance, but for the state assessment, those are through 2023. So a pilot would again give the opportunity to be able to determine longer term funding for that.
Thank you, Michelle. Next, we have Delegate Collison, followed by Senator West.
Thank you, Madam Chair.
Pleasure.
And I too am grateful for the information, Joanna. Thank you. I do want to push on the pilot a little bit. I am intrigued by the notion. I just don't know how you accomplish a pilot of this nature. Is it that we offer the subsidy to a certain amount of folks who meet our standards and then look at impact? I just don't know how it works. So and maybe it hasn't been worked out yet, but I'd be interested in hearing how you thought it would work.
Sure. So I think what we were thinking would be not in terms of specifying the specific target population necessarily for a pilot, but more so just setting potentially a time limit if that's what the legislature wanted to do, of saying maybe a 3-year pilot, which we're confident we would have funding to support, or if we do end up getting approval to spend federal funds through the reinsurance program on this, that could be extended to be a pilot through the end of the next waiver term if we extend the reinsurance waiver to be for another 5 years through 2028. So there's a couple ways to think about it, but I think it was considered more in the frame of just a several year kind of time limited duration that could then be revisited and extended based on the data we gather in the funding situation.
So it would actually be available and marketed as if it were going forward. And then in 3 years, though, if we found, it could end. It could be a program that could end if it didn't meet what we were intending it to. Okay, all right.
The thought, yeah.
Understand it better. Thank you very much.
Thank you for your question, Delegate. Senator West.
Thank you, Madam Chair. So I've got a two-pronged question. Let me start back on slide number 10, which is the one that covers the projected inflows and outflow. So it looks to me, based on this graph, that the funding from the federal government, as well as the state charge against the insurance companies on premiums, is producing considerably more money each year than is needed for the reinsurance. Am I correct in that?
That's correct. And I do want to say that's our projections. So we get the federal funding from the federal funding annually. So we only know what it is for 2019 and 2020. The future years are projections, as are the cost of the program is also projected. perspective.
Okay, well, let me ask one more question with this, and I want to go on to my ultimate question. So what is being done, or what do you expect will be done with all those extra dollars that are being brought in, but won't be used to pay for the reinsurance in the next couple of years?
Well, that's a great question. So the funding can roll forward to be spent on the reinsurance program, and in fact, that's what it has to do currently. So to the extent we wanted to use that funding to continue the reinsurance program, if we didn't spend it on anything else at the end of 2023, we would still have at least the unspent state funding if our projections hold. So that state funding could continue the reinsurance program absent any federal funding for perhaps another year or two, but then would dry up if we didn't have any kind of federal funding to supplement it with. So that's one option. If we continue the reinsurance waiver, we still have to hear from CMS on this, but we could potentially roll the unspent federal funding forward to use in a future past 2023 for the reinsurance program. Or, that's why we're also studying other options to use this funding for efforts to stabilize the individual markets. So, for example, we could use it on a state subsidy program.
I couldn't hear that last part. We could use it on a what?
We could use it on a state subsidy program.
Oh, okay. But we need the federal permission to use the federal money for that. We could use the state.
That's correct.
Okay. So, well, that's all very interesting. I wasn't aware that we were banking money on the reinsurance program. That I guess it's good because there's no assurance that federal money will continue to come. Although I would think in the next administration, it's much more likely that it would continue to come than it would have been if the presidential election had gone the other way. So let me come to my ultimate question, and that is, by the way, congratulations on an excellent presentation. And when I say excellent, it was so complicated, I had a hard time understanding it. So I was paying attention to every single word you said. So at the end, what I came up with is if we choose the AASE LI-40 option for young adults, it would mean 21,000 more enrollees. We currently have 156,000 who are not enrolled. So that would cut the number of unenrolled people down to about 135,000. So it makes a dent in the situation, but this is by no means a panacea. We're not going to solve the whole problem with this proposal. Do you agree with that?
Yes, that's accurate.
Okay, and you're saying that you think we have enough money at the moment because the program is creating a surplus that we can afford to pay for this rather modest program to add 21,000 more enrollees per year.
Yes.
Okay, thank you very much.
Thank you.
Thank you, Johanna, for being so, just having a great demeanor as we ask these questions, and impressive presentation. Are there any other questions? I don't see any in the chat room. I don't see any under the participant with a little hand. So are there any other questions for Michelle or for Johanna? I don't see any. Well, thank you, Michelle and Johanna. If you just hang tightly, because we're going to need you for this next section of the agenda. So on the agenda, we have the recommendations on adopting a state-based subsidy program for the individual market, which you just heard, and also the impact of COVID-19 on open enrollment. Now we come to the interesting, fun part of the agenda, where we're going to discuss the Maryland Health Benefit Exchange recommendations on individual subsidies, which you just heard. And we're going to also discuss connecting the easy enrollment program and the unemployment insurance program, which we heard the last meeting that we had a few months ago. And then, is there still interest in hiring an actuary to study whether Maryland should implement a Medicaid buy-in program? So those are the issues that we're going to discuss. This information is important for staff, so that they can get our feedback, they can complete their report on time. There's a lot of work to do between the holiday and the session. So we need to make sure when we get their emails on the draft that we reply immediately and we help them out. So Senator Feldman and I, thank you for your participation. And under chapters 37 and 38 of 2018, in Chapter 417 and 418 of 2019, and Chapters 597 and 598 of 2019, this commission that we're sitting on was required to include in its 2020 annual report recommendations, which is this year, December, basically for group and individual insurance market stability. The legislation specifies several options for the commission to consider. So I just want to give you just a little history and review for those that are at home and for the commission, where we are and where we're going. So basically, some of those recommendations we have discussed already. Some of the commission, the recommendation we determined to table for the time being, and some of which the commission has yet to make a determination, which is what we're going to do today. So in response to the commission work, the state has applied for a 1332 waiver and established a reinsurance program, which has worked beautifully. We've been able to lower the insurance premium in the last 3 years. And we have been able to get more people cover. People have also, joined and are receiving the Medicaid as well. And those numbers have gone up. We have 1.5 million people just on Medicaid in the state of Maryland. And our population, it's about 6 million, just to give you perspective. So basically, we established the Maryland Easy Enrollment Health Insurance Program. Thank you, Vinny, for that work, and require the Easy Enrollment Health Insurance Advisory Work Group to recommend to the General Assembly by December 31st, 2022, whether the state should implement an individual responsibility amount and or implement automatic enrollment in qualified health plans. So that's what we have done. The commission decided to table the discussion on standard plan design, if you recall from our last meetings, merging the individual and small group markets and establishing a basic health program. And that decision was basically made after we heard from our experts and we had a robust discussion and decided to make that recommendation. So the commission needs to discuss the following today: whether we should pursue a Medicaid buy-in program. Last year, the commission requested an actuarial study on whether it will make sense for Maryland to implement a program, and if so, what the perimeters of the program should be. Due to the budgetary uncertainty caused by COVID, and we could not have predicted that, the study was not performed. If the budget allows for an actuarial study in 2021, is the commission still interested in having the study completed? So that's one question I want you to think about. The second one is whether to provide additional subsidies. You had a very impressive presentation today, we had, where the Maryland Health Benefit Exchange discussed this. If the commission seems favorable towards moving forward, what additional information is needed? And we have whether to extend the state reinsurance program and how to fund it as well. And then the last issue is the commission also needs to discuss whether or not to recommend that the Maryland Easy Enrollment Program, Maryland Easy Enrollment Health Insurance Program and the State Unemployment Insurance Program should be connected, because there's so many people that are without work and are filing for unemployment. And it's a great idea personally, I think, to be able to connect people to the services that we have to the exchange, very similar to what we did with the easy enrollment. So let's take the first one, if we may. And what I want to do is tell you about the first one. Then if you have questions, suggestions, comments, let us know. And you have the experts here. Should we pursue a Medicaid buy-in program? As you know, last year, the commission requested a study. We had a robust discussion where we decided that the bills keep coming up regarding the Medicaid buy-in by my different colleagues, and we were required to look into it under the law. We decided to do the study, but then because of COVID, the study was not performed. Is this something that the commission would like to do? Let's start with that one first. And I open it now for questions or comment or concerns. Any questions on this? I don't see any questions. Delegate Collison and then Senator Feldman.
Well, no, I saw Lori Doyle said she
Okay,
had a question. I don't know if she just popped that up right now. I couldn't
okay.
relate it to this.
So let's go with Delegate Collison, then with Lori Doyle.
So thank you, and I'm sorry I couldn't find my raised hand fast enough.
It's okay. I saw you.
I was waving. I was using all my hands.
It works. It works.
I'm sorry that I missed the initial conversation by the commission on the Medicaid buy-in program. I guess my question is if we don't study it, then we won't know which would have the larger impact, a subsidy program or a program that would be accessible to the broader range of people. I mean, while I'm intrigued by the notion of the subsidies, it is very narrowly focused in order to get the largest impact, I think. But I'm wondering if there are ways for us to look at even a greater outreach, and does the buy-in option to Medicaid give us that reach? So my inclination is at this point is to say, I think that we should be looking at it. I think it is something that's going to be looked at the federal level. We can be ahead of the game by looking at how it affects our residents here in Maryland. So that's my early thoughts on the issue without the benefit of the previous discussion.
Thank you so much, Delegate. Lori Doyle.
Thank you, Madam Chair, and thank you, Senator Feldman, for noticing my hand up. Question, would we expect to have a federal match for the buy-in program, and would it be at the same 50%, the usual level of federal match?
I think that I would say that we don't know that, right? That's why we're studying it. I don't know if staff has anything else to add, but that's the reason for the study.
Thank you. From a behavioral health perspective, it's certainly an attractive option because of again, of course, the state, I guess, would have to decide the perimeters of the program, but the Medicaid option certainly provides a robust behavioral health benefit, and we expect that the impact of COVID is going to have a major impact on the number of people seeking behavioral health treatment. Thank you.
I don't know if staff or Senator Feldman would like to add to that.
Well, I think Jennifer might want to jump in. The only thing I would say is just remember, all we're talking about in terms of what we need to decide is if there's sufficient money in the budget next session, whether we're going to study it. We're not saying we have to do it. So really the question on the table for the commission is anybody opposed to, if budget allows to analyze this or study it or have an actuary? So, we're not recommending that we actually do it.
That's right.
Jennifer, you look like you were itching to weigh in here.
I just typed a note. Typically you don't get a match necessarily because the individuals that are eligible to buy into a Medicaid buy-in are not otherwise eligible for Medicaid, but there are other savings involved in terms of purchasing power and administrative services. It would all depend on how we set up the buy-in, how it could be funded.
So Madam Chair, maybe the question, if you want to present it to the commission, is who here is opposed to, budget with allowing it? Who here is opposed or has concerns about actually even studying it, or having an actuary study this?
Yeah, and that's how I'm going to end with all of them. So that's a good idea. So we had the discussion, you had your questions. So now the question is the question that Senator Feldman just put forward. Is there anyone that is opposed to pursuing this study? I don't see anyone. Okay, this is great. So staff is taking notes. So any other questions regarding this one? Beautiful. Oh, wait, Mr. Atlas.
Hi, thank you. I don't object to the idea of studying Medicaid buy-in. The more we know, better choices we can make. I just want to, as we think about where public funds might go, if they're going anywhere, We heard a lot in Johanna's presentation about premium subsidy, but there's also the fact that out-of-pocket costs are considerable for people even on these plans. And that makes them have challenges affording their health care when they need care, not just after they've got a insurance card. And so, I would just encourage thinking about, how do we make sure that the coverage is robust enough that it actually gives people the help that they need.
Thank you. Thank you for your comments. So we're going to move to the second issue that we now have to decide, is whether to provide additional subsidies. So before I ask the question whether you're opposed to it, you heard the presentation from the Maryland Health Benefit Exchange. You asked questions about it. You heard that they said that we can get a waiver, and the waiver, I think they've said they preferred in that last slide because you can get some pass-through federal funding, but that we did not need to get a waiver because we can do it with state funds. Correct, Michelle? She's saying yes. So, and then they discussed that there were 3 different scenarios that we modeled, and then they basically concluded, if I'm not mistaken, they concluded that young adults under 400% of the federal poverty level should be the initial target of a state subsidy program. And they said that uninsured young adults are disproportionately likely to be Black and Hispanics. And then I heard the discussion about whether or not it should be a pilot. And they said that the reason for the pilot was to have the flexibility, mostly, if we do not get any federal funds or when it ends. And Delegate Collison asked some questions regarding that. So that being said, are there any questions to help you decide whether we, as Senator Feldman put it beautifully, should basically vote to provide additional subsidies? Yes, Mr. DeMarco.
Thank you, Madam Chair. I just, not a question, I just want to strongly urge the commission to endorse the subsidies at the level the work group recommended, and it not be a pilot. And I would actually recommend that the commission have, as part of its recommendation, taking the sunset off of the 1% assessment and keeping that 1% assessment there so that the subsidies could keep going. I don't think it would be a good idea to have folks on a subsidy for 3 years and then take them off and have to say, well, your premiums now are going to go way up after you've been used to having premiums you could afford. I think Massachusetts, as we heard, has done a great job in bringing their uninsured rate down to 3% with subsidies, and California, New Jersey, Colorado, and Vermont have also adopted subsidy to work. I think it's a best next step for us to make the Affordable Care Act work better for Marylanders. So that's what I would recommend. What the work group recommended, with taking off the sunset on the assessment so that it could be permanent. Thank you again for the great presentation.
Mr. Walters.
I have a concern partially based on what Senator West said before. If funding right now is scheduled to run out in 23 and we have a surplus of money here, would we be better off looking at keeping that surplus to keep the reinsurance program going further if the subsidy does not continue, if the feds do not extend it? Because if we use up the money funding this, if we're not going to get a federal subsidy, we could then be putting ourselves in trouble, because the reinsurance program has worked fantastically. It's brought down premiums like we wanted. And part of the fact that we had the extra, at first we front loaded, if you remember, the first 2 years of how we were going to spend the subsidy. But since it worked so well, we had more money and we were able to keep the subsidy level at the reinsurance amount at the level it was previously to keep premiums down. So I'd hate to lose that. So I'd be all in favor of it, especially if I knew we were going to be able to get federal money to help support the program. But if it all came down to Maryland dollars, I'm not sure if that's the best use of the Maryland dollars.
Any other questions? I don't see any other questions. Okay, Senator West.
Yeah, I had my hand up, but it's easier to put this hand up.
Yes, I didn't see you because I was listening to Mr. Walters' answer.
Yeah, so I'm sort of, I get the same sort of concern that Sandy does, but maybe in a different way. And that is, we've identified now that the program that we initiated a couple of years ago, the reinsurance program, is actually generating more money than needed at the moment to pay for the reinsurance program. So this is an idea which would give 21,000 people more than we have right now getting insurance and reduce the uninsured. But are there any other ways the money could be spent that might be more productive? For example, suppose we use the money to reduce the inflection point at which reinsurance kicked in. That should cause the insurance companies to reduce their premiums. And once the premiums go down, more people would voluntarily sign up. Has anybody taken a look at that as an alternative to what's being it's on the table today?
Michelle or Johanna?
Yeah, that's a great question. And we did discuss this particularly with the MIA as we were crafting what we wanted to ask Lewis and Ellis to model. And the kind of conversation where we landed in our discussions with the MIA is that expanding reinsurance using our state funds wouldn't really have a significant impact on this under 400% FPL population, and particularly not on young adults, because the state funding that we have, while significant, as well as the unspent federal funding, is, once you spread it over the whole market, is not going to be enough to really make reinsurance substantial for those lower income folks because of the federal subsidy design. So if we did want to target folks under 400% or young adults or another subpopulation, that can't really be done effectively through reinsurance. And another thing that we kind of noted in that discussion is that Maryland has the most generous reinsurance program nationally currently. So there's kind of diminishing returns to continuing to make that more generous.
Thank you. So I have Deb Ripken next, please.
Hi, I just wanted to say that I agree with Mr. Walters completely. I do think it's really important for us to look at the reinsurance model and see if we want to focus on the benefits of how we've used the money, and the fact that in a couple of years, the reinsurance money, we won't be getting any more unless we continue asking for another waiver, and we could use that money for out years. I think that's really important for us to consider.
Thank you. Mr. DeMarco.
Thank you, Madam Chair. I think one of the most important points in the report was the equity impact here. Now, I'm a big fan of the reinsurance program, and congratulations, Madam Chairman, Senator Feldman, for all you've done to make that happen. It's helped a lot of people. But what this report showed is that people, lower income people, people of color, are not helped as much by the reinsurance as they would be by the subsidies. I think it's very, very important that we build on the success of reinsurance by doing something like these subsidies, using state money to go forward. I think that with the new Biden-Harris administration, I think there's a very good chance that the reinsurance will be continued and programs like that, but that we should use state money to help lower income people so that they could get the health care they need. I think this would be a really terrific step forward, and I'm thrilled that the exchange has suggested it, and I hope we could do it. And like I said, I recommend that we take off the limit on the assessment in 2023 so they can fund these subsidies for good. Thank you very much.
Delegate Resnick.
Thank you, Madam Chair.
My pleasure.
in general, I support more taxpayer dollars going to fund subsidies towards insurance. As the appropriator on this panel, one thing that was, pardon me, excuse me. This always happens. As the
It's okay, they want to be heard too. They have an opinion.
I have to ask the question, something that was not addressed is, where are we going to get the funding for this? We are looking at cuts to the budget this coming year. We're looking at a deficit going into the year before COVID. Things are better than projected during COVID, but we are still looking at cuts. You know, the funding's got to be found somewhere, and it's going to be found out of my subcommittee. So where are we finding the state money for this?
Michelle or Johanna?
So the state funding is already assessed. That is the assessment that we applied, the 2.75% that was assessed against the carriers for 2019. And that funding is already there. And then going forward, we've already assessed the 1% on health plans for the 2020 through 2023. So that's already solidified. We don't have to come up with any new money.
So if we don't do the subsidy, where does the money go?
Well, right now it's just in the reinsurance fund. It's allocated, it's in the reinsurance fund, the exchange reinsurance fund, waiting out there for reinsurance if needed.
So if we don't do the subsidy, we have money waiting in the reinsurance fund for when reinsurance is not renewed, assuming. But if we do the subsidy and reinsurance is not renewed, program ends.
Right now it has a dedicated use of reinsurance. So it's in the reinsurance fund with a dedicated use today.
I understand that. Is it being spent today?
No.
So it's just sitting there waiting on the off chance that reinsurance is not renewed. It's sitting there waiting for us to be able to extend the program.
Correct.
And if we do use it and reinsurance is not renewed, it's all gone.
Correct.
Okay, thank you.
Any other questions or concerns?
Actually, I have one.
Well, Senator West and then Mr. Walters.
Do we have any reason to believe that we will know a year from now whether or not the new presidential administration will be willing to extend the reinsurance program, which would give us more confidence that the money will be there in the future to pay for these subsidies? I appreciate Deb Rivkin's concern that the program might disappear, and Kirill made it clear that if it disappears, then the money that's not being spent right now will be needed to extend the program as long as we can. But I wonder whether we have any confidence that within the next year, once the new administration takes over, that we will get some definitive resolution of whether the program will continue, in which case this conversation might be more appropriate a year from now than it is now.
So I can share from the circles that I'm in that we feel very confident that the new administration is going to really continue to support the Affordable Care Act and looking at building upon the Affordable Care Act. As far as the state-based exchanges go, we have collectively already submitted our wish list, so to speak, to the transition team. And I know others have as well. So we're pretty confident that there'll be more support in the future for the Affordable Care Act and building upon it.
Thank you. Mr. Walters.
The one positive thing one of the positive things I'll say about this program, according to the chart, it will only cost about $3,300 per additional subscriber, which is much more efficient than a lot of the other programs and the base program for getting enrollment into the exchange and other things. So it's a cheaper method than some of the methods we've talked about in the past for getting people insurance. So that's a good thing about this program. I just worry about the overall long-term funding of both of these kind of programs.
Thank you. Are there any other questions or comments from anyone? Seeing none, this is where we are. We are split, okay? So I have this proposal. The objective of our commission is to make sure that people are covered, that they have health insurance. That is the objective of this commission. The reinsurance program worked really beautifully. We have more money than what the program cost. So the policy decision here is, do we keep the money because we don't know what the future holds after 2023? And depending on how much money that is, we don't know how many people that will be. Or do we try to be impactful and try to cover young people to instill in them the habit of having insurance? And with the new administration, we feel pretty confident that they will be supportive. And can we split the baby? Excuse me for using that expression. My kids will not appreciate it. Can we compromise on a pilot program and see how it works and give the legislative body the flexibility to be able to, change it and opine and be part of that decision, however it's worded in legislation. So I'm going to ask the question this way: who objects to going forward with what I just described in having a pilot program that will not be beyond 2023? Okay, they can be, whatever, couple years, and see and have some language in there that you must report to the legislature, that you must give feedback and make us part of the process and keep us informed on the money. And as soon as you find out from the administration, that you keep us informed. So if you could raise your hand if you're opposed to that proposal. I see Deb Ripken. Out of all of us, only one person. So I would ask staff.
Excuse me, Madam Chair, I did not oppose. If you saw that, no, that was
You know
not
what
me.
it is, Deb? You know what it is, love? Your hand is still up. Can you lower it, please?
This is technology.
It's
Give me a sec. No, I did not oppose this. Oh my goodness.
It's okay.
Thank you.
I make that mistake all the time.
Okay.
Mr. Atlas. Thank you, Deb.
Just a comment, not to oppose, but since we've referenced the Affordable Care Act, we do have one little fact of life, which is that the Supreme Court is going to render a judgment on the future of the Supreme Court within the next few months. We're assuming that they will keep it alive. I think everybody is betting that they will at least sever the good parts, keep the good parts, or not the, you know what I mean, the part that we're talking about.
Constitutional. Mm-hmm.
Yeah. But if you go ahead, it's got to be contingent on the Affordable Care Act not being blown up.
Yeah, I think a lot of we codify into law a lot of these consumer protection provisions with Senator Feldman's leadership and Chair Pendergrass. So we know we have to have a lot of discussion in the future, depending on what happens. But I think people feel pretty confident that, they will hold that, it is constitutional without the individual mandate. But that being said, I don't see anyone objecting. So staff knows clearly how to draft it. Are there any questions from staff regarding this? Is it pretty clear?
Madam Chair, could I just throw one thing?
Yes.
For you, Bob, if the ACA is thrown out in its entirety, we have a bigger problem.
That's right.
We're talking loss of all the Medicaid dollars and federal subsidies. We have a $4 billion hole in our state budget. So we're very mindful of that. But I think if the ACA were not surviving in any component of it, we have a major budgetary problem. Delegate Resnick, I'm sure, has all the answers to what will happen when we lose those billions of federal dollars. But no, we're very mindful. Obviously, that's a game changer in every aspect of healthcare in the nation.
Thank you.
Delegate Resnick.
Just as a response to Delegate Feldman. In fact, I do have the answers. So, you know.
Oh, that's true. I forgot about that.
I love you guys. All right. So the next issue, and thank you so much for a robust discussion. The next issue is whether to extend the state reinsurance program and how to fund it. So I think, and I have not opined on the others, but on this one, I think that we want to stick with what we have for the time being. We have a waiver, a program that is working. It is good till 2023. We have a new administration. We're hopeful about its support. Maryland has one of the most robust reinsurance program in the country, and it has worked well. The federal government did away with the 2.75 health insurer fee, and Maryland has implemented a 1% fee in its place. So I don't think you fix what's not broken, and I would submit and ask this body basically who opposes living things the way they are for the time being. All right, seeing none, staff has our answer. The final issue for discussion today, and then you're free. I'm standing between Zoom and you. The commission, we also have to discuss whether or not to recommend the Maryland Easy Enrollment Health Insurance Program and the State Unemployment Insurance Program, whether or not they should be connected, those two programs, the Easy Enrollment and the Unemployment Insurance Program. Vinny at the last meeting brought this up, and I think everyone agreed. Stan Dorn reports that he has reached out to the Department of Labor and has not received a response. I think we're still unclear on what the federal limitations may be, and the recommendations should learn more towards the Department of, we will learn more about the recommendations once we hear from the Department of Labor and the Maryland Health Benefit Exchange as well. So the question really is, in very simple English, is, should we make this connection? And we have Michelle Everly first, then we have Senator Brian Feldman.
I know we're not here to testify on this, but because I have a piece of information you'll want to know. We're in the process right now. We received a letter from the task force, the Attorney General's task force on COVID, asking about this particular issue to the Secretary of Health, the Secretary of Labor, and myself. And we've drafted a letter in response that is going to address exactly what you're talking about, the limitations that Department of Labor has. In a nutshell, everything is around funding because Labor cannot use any federal funds that they receive for any work. But anyhow, that letter is forthcoming any day now. It's just out for signatures. But I wanted to share that information with this group as you're talking through this. There will be funding that will be needed.
Thank you. Senator Feldman.
Yeah, well, I would just remind, we started floating this idea, I think, even before the pandemic hit. And the reality is, when you lose your job, because such a high percentage of our nation gets their health insurance from their jobs, when you lose your job, you're at very high risk of not having health insurance at this point. So this, I think, made tremendous sense, I think, from the get-go. And we did know from Stan Dorn and others that this actually is in play in Kentucky and some other states, and they haven't run into these federal hurdles that I think our Department of Labor keeps referencing. But if you really want to see a great case for why we should sort of partner these two items together, UI and a check the box, similar to how we deal with the easy enrollment, take a look at the op-ed piece in the Baltimore Sun from 2 weeks ago, authored by none other than Delegate Peña-Melnyk, myself, Senator Rosapep, and Delegate Charkoudian. This fantastic op-ed piece prominently in the Sunday Baltimore Sun on this very topic. And so I would urge those of you who have not read that to go ahead and read that. But to me, it makes sense. When you're applying for UI, why not just check a box and have the same processes play out, just like we're doing this year with the easy enrollment plan. Now, Michelle, I am looking forward to hearing what these restrictions are in the funding topic. And again, I referenced the Kentucky experience, and there doesn't seem to have been any problems in that regard. But that, and then one final point, unlike some of the other things we talked about today, I don't think this requires a bill. You know, the Department of Labor can do this administratively. I mean, unless somebody has a different take on it, we don't have to legislate this. We just need to persuade them that this is a really good idea. Unlike the easy enrollment program, we had to pass a bill to pull that off. So does anybody have a different view on that? I mean, is there any reason we need a bill to basically have the Department of Labor at the time of an unemployment insurance claim advise the Department of Labor, who can then share that with the exchange, the fact that those folks don't have health insurance? Michelle, do you have any thought on that more narrow point?
I will tell you that now with the new beacon system that the Labor has, we are working with Labor to actually try and ping that system. So we'll get almost real-time data from Labor in terms of Medicaid determinations, et cetera. So there may be other things that we can do in the future. And we've reached out to Labor to say, you know, let's use the resources, the technical resources the exchange has. How can we help? How can we facilitate it? So we certainly are working very closely with them, and we've got some things in the pipeline coming down first quarter of next year. And we'll continue to work however we can to really, you know, to support what the efforts we're already doing with Labor to get people insured, but there may be other opportunities there next year.
I guess, Michelle, my question is, do either you or the Department of Labor need any kind of enabling legislation from the General Assembly in order to do what we're talking about here? I mean, is that?
No.
Okay.
So Jennifer, did you want to be heard? Okay, all right. So thank you, Senator Feldman. Thank you for your leadership on this issue, because I think this is a real important issue that will make a difference, especially people that are without work. They can easily qualify for Medicaid and are not being reached, or for a policy that they're able to afford. So I really appreciate your leadership. Are there any other questions or concerns regarding this? So basically, I'll put it like Senator Feldman said it beautifully. Anyone objecting to this? Does anyone object to the connection? How can you object to any connection? Anyone? No, beautiful. So staff knows what how to draft it. So thank you so much for being so kind, and for, you know, I hope you felt that you could participate, because this is everyone's meeting. Senator Feldman and I are just here to give a little guidance, and staff, you know, really prepares us for these meetings. So don't be so impressed, because they're the ones that write the notes. So I thank them. So now we come to the part of the timeline. So Lisa and Jennifer, when do you expect to draft it? When, you know, can you give the commission guidance when they should look at their impacts and how fast they should get back to you so that you can enjoy your holiday?
I'd say we can have a draft done probably within the week.
I think that's good. We'll get something out by the beginning of next week, and then if we give you a week to get us, is that enough time?
Yeah.
That would be like the 21st or 22nd that you would need to get back to us by.
That sounds great. So what I ask of the commission is to please, I know we're all busy and these are the holidays, but will you be so kind and check your inbox and please reply immediately, okay? Because your input is important. You come to these meetings, you're heard, and it should make it into the report. I want to thank the Maryland Health Benefit Exchange. Today was their show. They did a beautiful job. Thank you so much. And the reinsurance program, you know, we're just a mouthpiece, the senators and delegates, no disrespect. You know, a lot of this work for the reinsurance program and the easy enrollment and, you know, was done by the advocates and the insurers, you know, Care First, You know, all the other one, Kaiser, all the other ones that came on board early and helped us out. We couldn't do it without them. And the Hospital Association, always a great partner. So I hope that you have an amazing holiday. Please stay healthy and safe and wear your mask, please. And I look forward to seeing you in Annapolis. And thank you, Johanna and Michelle, for an amazing job. Take care.
Okay, thank
Happy
you.
holidays.
When I didn't ask Senator Feldman.
No, look, I would echo everything Delegate Peña-Melnick said. You know, these reports that we've done the last 3 years have really forged a foundation for some really cutting edge, great stuff we've been followed up during the legislative session. And so I think going into the 21 session, I don't think it should be any different. I think what we talked about today, you know, in the Senate Finance Committee, we've got Chair Kelly here, which is great to have her part of this. But, you know, we've done some really great things the last 2, 3, 4 years. And a lot of it's a direct result of the work of this commission and then the report that our great staff does. So thanks. I guess this brings an end to the 20 year, but we still have to get the report issued by December 31st. And so
Yeah.
everybody.
And I want to thank Senator Kelly for your work in the Finance Committee, because every bill has to pass both houses. So thank you for your leadership on the committee. You really make it easy for us, and we're really grateful. Have a wonderful holiday, everyone, and please take good. Oh, Senator Kelly.
Nothing. Everybody have a holiday that,
Oh, beautiful.
that you deserve.
Thank
Okay.
you. Take care. Bye-bye.
Bye-bye.
Bye.